Hello, friends. Welcome to this special episode from Weekend Investing. As you know, we do some analysis based on past data and try to drive insights into the markets. Today's topic is again on gold. The markets are feeling the pressure of the new heights that it have gone to, and gold is your friend to help you there. But that's not what we're going to talk about. We're going to talk about how gold has performed in various interest rate cycles, and we are at the cusp of an interest rate down cycle in India as well. So let's look at some data from that point of view, and I'll try to enumerate the many reasons people give why gold is going up. Although from our perspective, the why is not important. The fact that it's in a very strong upward long-term trend, and that allocation to gold is a must regardless of where the trade may be looking like. That is the bottom line from my perspective, at least. And in Indian context, barring the last, I would say, 8 or 10 years, there has never been a time where gold has performed so well along with equities. So, if I were to go back to, let's say, the 90s or early 2000s, whenever equity used to be performing very nicely, uh, gold was never performing. When equities was going down, gold used to perform. Now, what is happening is that gold is just continuously going up, and there are henceforth some reasons have changed over the decades why gold is getting accumulated, and we'll discuss some of those also in this video. So get some popcorn and sit back, because this is going to be slightly longer one. So now this is where we are in terms of gold versus equities. Everything is in a Goldilocks scenario. Um, all asset classes are going up. In India, especially, real estate is going up at its all-time highs in most locations. Gold is at an all-time high despite the government cutting the customs duty. Equity is almost at its all-time highs, barring the few percentage drop that we've had. So, what are the common reasons that are being given? Now, there's something called the real interest rate, and there's a nominal interest rate. So, when you subtract inflation from the nominal interest rate, that is when you get the real interest rate. So, real interest rate plus inflation is the nominal interest rate, and that plays a role in terms of how attractive gold is as an investment. So, this very unique chart from Game of Trades shows you that in the last uh, about 20 years, something has changed in the last 2 years. This is, I'll explain this chart. The black line is the 10-year treasury yield, the real yield. So again, nominal minus inflation. And the golden line is the price of gold, but it is inverted. So 1 divided by price of gold, just to show the, uh, uh, the that these two patterns, these two lines are going along with each other, and there's a very strong correlation, direct correlation. So you can see from 2007 till 2021-22, pretty much every time the treasury yield would drop, the real treasury yield, gold prices will go up. Every time the treasury yield would rise, gold prices would drop, and so on and so forth. But something happened in 2022 which changed the equation which was being followed for 15 years. And while the real interest rate for the real yield continued to go up, gold also continued to go up. This is an inverted chart, remember. So something broke down here which caused this past correlation to change. And regardless of whether treasury yield is moving down, gold is moving up, and now treasury yield is moving up and gold is also moving up. So gold is moving up regardless of where treasury yield is going. That is the takeaway that I want you to have from this chart. Now, on a very basic level, the rise in interest rates decreases the attractiveness of gold, because when the real interest rate rises, an investor has other options other than gold to go and get that yield from, right? So treasury bonds may become more appealing, but that is a normal period scenario. Right now, it seems that we are not in a normal period, and hence we saw this very strange phenomena that is happening. So in real interest rates, which have stagnated in the last year or so, you can see here the blue line is the real interest rate, and this is the effective rate. And inflation rate is coming down gradually. So higher real interest rates obviously will make people go towards bonds and less towards gold. So what happened to US yields recently? Recently, US bond yields have declined due to expectation of monetary easing, and 0.5% of the cut has also happened. The first cut has happened here, and more are expected to go down. But the yield has already come down before even the Fed could cut the first rate. So bond yields have dropped more significantly than the inflation. You can see here the yields topped out last year, whereas Fed fund cut rate cut has happened only now. So this was the sort of market expectation that is already built in from 5 to 3.7, and we've now got a 0.5% cut. 2 year also is similar, where some peak was made in September, October last year, and now we are at the bottom of the last 2 years or so. So what happens when US interest rates declined in the past? Uh, so the classic example is from the 70s, where there was stagflation and inflation surge. So this was the period of extreme, I would say, mismanagement of the US balance sheet, and they had to print like crazy because they were spending very big on the Vietnam War, etc. And if, for that reason, the inflation really went out of control, and there was no real growth happening. Uh, so phase one in the late 1970s, the real interest rates went negative because inflation was very high, uh, and the gold price surged. Um, so if we see the gold price in the 1970s, and this is all dollar based, you could see that a 2,251% gain happened in that decade with a CAGR of 42%. It's unimaginable, but that's what happened. And of course, in 1971, gold was taken off from the backing of the US dollar. So US dollar was no longer backed by gold, and that also caused gold to seek its natural price. And that's why you got this surge along with that. In the post dot-com and financial crisis, again, you saw the interest rates and the yields collapsing. And after the 2001 dot-com bust, the rates became extremely low here and virtually went to zero after the 2008 crisis. Gold again zoomed in this period, going from nearly $250 to almost $2,000, 603% gain with a CAGR of 20% in this period also. So both these periods coincided with very low or negative real interest rates and high inflation. Then, even in the post dot-com period, that was the case, where the real interest rates fell into negative territory as Fed cuts nominal rates to near zero and gold surged to an all-time high in the COVID phase. This happened very, very quickly. So as soon as the COVID strike happened, Fed went into the rate cut mode in a emergency mode and cut very, very rapidly here. You can see how rapidly the rates were cut, and that caused a complete up melt up, you can say, in gold prices post the COVID crisis here. So why is gold going up now? Um, yeah. So one thing to also understand is that the first cut in the interest rate brings the maximum sort of momentum into golds, and I'll show you that chart. This is the gold chart for the last few years, and the gold price has been anticipating the rate cut cycle from as far back as end of 2022. And you can see here, this chart is from Incrementum, that in every down cycle of interest rate, so this black line is the Fed funds rate. So every time the interest rates are cut, this is the first cut starting from here, gold goes up. So 31% is the rise in gold during this cut period, 39% in the 2008 cut period, and 26% in the 2020 COVID period. And now we've witnessed the first cut, and we are currently where we are in terms of gold price at an all-time high. So given this past movements, and maybe some of it is already baked in, there is a good chance that gold is going to rally from here till such point that the lowest part of the interest rate cycle is reached. Um, the dollar index also plays a role in terms of investors' outlook towards gold. Um, a weaker dollar, a dollar index is basically an index made up of six currencies other than the dollar, and the weaker dollar just means that dollar is weakening against those that basket of currencies. And when dollar weakens, it means that money is moving out of the US dollar or US dollar denominated assets, and then it likely is to move into non USD assets or gold. uh, so a lowering of dollar index always is also a signal for gold to move up. Then besides these factors, there are factors of currency debasement and money supply. This you already know how much of debasement and money printing has been happening, especially in the last 4 or 5 years. And if we see the last 25 years for all currencies, dollar, euro, Swiss franc, rupee, the essentially these fiat currencies are losing value versus the gold. So the ideal way is not to compare gold to equities, but the ideal way is to compare gold to money, and money in form of fiat. So if fiat currency, $100 bill in January 2000, what it could buy, that purchasing power has collapsed totally. In 2024, the same $100 bill cannot buy much what it used to buy in January 2000. And versus if whatever gold ounces you could buy for $100 at that point of time has the same purchasing power as what the same amount of gold can buy today. So that is the sort of the key, comparable for a hard money, what it is called, to be compared with. So all these currencies just continue to print, and that causes inflated debt and causes high inflation. And inflation is the secret tax, as you very well know, that's how the governments are able to tax you without you even knowing. And this is beyond the all other taxation that we are subject to. Uh, so, for instance, in gold terms, dollar's value in August 2024 was only 11% of what it was in January 2000. So that is the kind of fall of the purchasing power of dollar versus an ounce of gold. Uh, an ounce of gold is also changing very rapidly versus the crude, for instance. So in 2024, an ounce of gold was worth 30 barrels of crude oil, and it was only 11 barrels of crude oil in 2000. So even crude has underperformed in a very big way versus gold. And if crude were to sort of regain its dominance, then we could easily look at crude in high triple digit numbers. And that if happens, you can very well understand what happens to the debt denominated balance sheets that we all have in every countries. So gold to Sensex chart has started to now move up as gold is spiking up, and maybe Sensex is coming to some sort of a range or a plateauing a point. But if in the longer, larger concept, if we see, then gold to Sensex ratio actually moves between, let's say, 0.07 to zero point 0.2. And in each bull market, so in the 2000 uh, .com bust, you can see gold to index move up. Then 2008 bust, you can see gold to index move up. Then COVID crisis, you can see gold to index move up. So here we have started to move up now. I don't know if there will be a bust of any sort on the index, but if this ratio comes to 0.15, zero point 0.2, somewhere here, that will be the time then maybe over allocation towards equity should be tried. And here at the bottom is not the place where you should be overly allocated to equities. Here you should be overly allocated to gold, in fact. But even if you have a healthy allocation to gold, I think that helps over a period of time. Then another factor that has been very, very instrumental in the gold price going up has been the accumulation of gold by Russia and by China and all other uh, central banks who are shoring up their gold allocation in their reserves. So China, for instance, from 2015 has more than doubled its reserves in gold. And what they're doing is they used to have about $3 trillion worth of US Treasury in their reserve. They're gradually chipping away at that treasury. So from three to two and a half to two. And I think they're now below $1 trillion. So they are getting rid of any holding of US Treasury because US has, after the Ukraine war, when they froze Russia's assets, it gave a very strong signal to every central government out there that if you are at loggerheads with US anytime, then they can just freeze your assets. And treasury is basically IOU from the US to the China. US can any day say that I owe you 3 trillion, but I'm not paying you. Right. So uh, China, in its own wisdom, and rightly so perhaps, is reducing its exposure to the US treasuries and buying gold instead, because Mr. Trump has very openly said that if he comes back to office, he is going to put a trade embargo of 100% on Chinese goods. So China does not want to have that kind of a risk with the US markets. Individual China demand is also growing very rapidly, because real estate has weakened there, and stock market hasn't really gone anywhere. Just the last 1 week there has been some bump up, but for the last decade they've done nothing. And hence, people in China, in even yuan terms, if they see their exposure to gold and the performance of gold, that is the only asset class that has made them money, and hence there is a good following for buying gold there. And we are sitting in a year of extreme uncertainty. Just as I am recording this video, there is news of firing at the by Israel, and 220 rockets have been fired or something like that. So there is going to be uncertainty, and uncertainty is always there around US elections also. And the fact that more and more pockets of disturbance are going up in the world, and that creates more scope for gold to do well actually in that period. So central banks are piling up gold, and they're not doing it without a reason. There is a reason for it. We should sit up and look at them, why they are accumulating gold, why they're not accumulating palladium or platinum or silver. But gold is meaningful in the monetary world, and it's making a comeback of sorts, to be held with in central bank reserves. And if central bank reserves can hold significant amounts of gold, I see no reason why we should not be doing the same. And so it is time to sort of have a good asset allocation towards gold. Your financial advisor will tell you how much, but most financial advisors have been tinkering with gold allocation at 1, 2, 4, 5, 10%. I don't think that really helps. But of course, I mean, your advisor is your advisor. So think and act wisely. I think there is uh, enough evidence in front of you why you need to have that exposure and save your portfolio and build an insurance for your portfolio. Have gold act as a hedge against your portfolio. I am not at all recommending gold for returns. I'm recommending gold to save your purchasing power and for wealth preservation at your end. Let me know how do you like this content, and if you have any questions or comments, I'll be happy to engage with you at on YouTube comments. Thanks. Bye.